All right, this is the eighth video on the Definitely series, and it's the second video on the enterprise value and equity value section. And today we're going to be talking about non-controlling interests, and that's actually a somewhat of a unique addition that we do to go from equity value to enterprise value. So to go over the concept really quickly, the way that I like to think about it is let's first talk about like what the definition of a non-controlling interest is, right? And to understand that, we should understand what a controlling interest is, right? And then from there we can figure out what a non-controlling interest is, right? So when I say that, oh, I have a controlling interest in this company, what does that sound like? It sounds like I have some form of control over a specific company, right? And the interest that refers to like ownership, right? So if I was to kind of give a definition, right, it seems like I have a controlling, right? If for some reason I'm able to control like a portion of a company, right? And I have a majority of it, so I kind of have this level of like ownership, right? And through that I'm able to control this company, right? So naturally, a non-controlling interest should mean that I own some portion, or I guess it's there's ownership of some portion of a company, and that does not lead to control, right? So if I give you an example, let's say that there is a company, right, represented as this pie chart. And let's say it's like a drone company, and it's worth $100, right, in total. Well, let's say that I personally own $75 worth of this company, and my brother owns $25 worth of this company. Well, then, who has the controlling interest and who has the non-controlling interest? I'm going to abbreviate that as NCI. Right? Well, it seems like I have the controlling interest. I would be able to make decisions around this company, and my brother would not really have a controlling interest. It would be a non-controlling interest. Now, here's where we'll hop into like a more typical finance example. And the rule here is that if you own a majority of a company, right, so you have a majority stake, which we can basically say is a controlling interest in a company, controlling interest, that means you must recognize all of that company's income and expenses, right? So let's think about this in this way. Let's say that I own an AI company, right? And on our AI company, we have some amount of, and I'm building out an income statement here, our revenue, our costs, whatever the case is, and we get some amount of profit, right? But I decide to use the AI company's money and I acquire a bicycle company. Now, let's assume that I own 51% of this bicycle company. Well, in that scenario, let's say that the bicycle company has revenue of 100, it has costs of 10, right? When I look at my AI company's income statement, right, or this is the income statement, I am not going to recognize $51 worth of revenue and $5.1 worth of costs. I am not going to do that because at the end of the day, I have a controlling interest of this entire company, right? So with that, I need to recognize the full 100. So the full, let's make this in green. The full 100 and the full 10 go in as revenue and as costs, right? So I'm essentially taking on the entirety of the revenue, the entirety of the cost, because I actually am controlling this company. I have a majority stake in it. It's my full company, right? So how does that tie into our enterprise value and equity value, right? Now, if I'm trying to value my AI company, right? And I'm looking at the enterprise value. We know that this is equal to the equity value. This is equal to the, say, net debt. It's equal to the preferred shares, right? But now I also need to add the portion of this bicycle company that I don't have a controlling interest over. And the reasoning for that is that by having a controlling interest, meaning that I own a majority stake of it, if I'm trying to value the entirety of this AI company is able to control the entirety of this bicycle company. So with that in mind, the value of the AI company should also include the portion of the bicycle company that doesn't currently fall under the ownership percentage that we have. So another way, I'll write down non-controlling interest. Another way to look at it is the AI company owns a majority of this bicycle company, meaning that they are essentially kind of like a dictator to this bicycle company. They can do whatever they want to this bicycle company, and the other 49% of this bicycle company can't really say anything, right? So isn't that kind of equivalent to just saying that this AI company owns the entirety of the bicycle company? It's not perfect, right? But that's the way that I kind of want you to think about it. Another way, and we're going to talk about this in the next video, is that if you're trying to compare our enterprise value in relation to our, let's say, our revenue, it doesn't make sense that we would compare our revenue, which includes 100% of our revenue and cost of our bicycle company, right? Or in this case, the revenue of the bicycle company. So this has 100% of the revenue from the bike company. And then we don't take that into account on our enterprise value. And on our enterprise value, we're only going to recognize 51%. That's not comparable, because if I'm saying that the enterprise value of a company in relation to the revenue is, let's say, like 10 times that revenue amount. So if this is 100, and if it's 10 times, then this will be 1,000, right? If our non-controlling interest revenue is included in this figure, then we have to make sure that it's also included in the total value of the company. So that's two ways to kind of think about non-controlling interest. Now, how you would get this question in an investment banking coffee chat or interview would be typically, what's the formula for enterprise value? Or how do you get from equity value to enterprise value? And then you would say something like, well, enterprise value is equal to equity value plus debt minus cash plus preferred stock plus the non-controlling interest. And then the interviewer would follow up and say, well, what is non-controlling interest, right? Or why do you add non-controlling interest? And then in that scenario, you're essentially going to explain this piece that I just laid out, right? So you can kind of say that, oh, well, whenever we have a controlling interest of a company, we recognize the entirety of its revenue and its different costs. So because of that, we need to make sure that it's an apples to apples comparison, and our enterprise value needs to take into account the non-controlling portion of that company. So that's why we add in that non-controlling portion of the company. So this is a honestly pretty common question, especially if this is how you describe your essentially equity value to enterprise value bridge is what some people call it. So if you say non-controlling interest, I think you should be ready to essentially follow that up with what non-controlling interest is. Now, personally, I would recommend that you do say non-controlling interest. I think that's the more correct formula. But if you really, really are in a time crunch and you don't really have time to kind of fully understand what a non-controlling interest is, I do think that you can take a little bit of a gamble and just say that it's enterprise value is equal to equity value plus debt minus cash plus the preferred stock, right? Maybe they will give you a hard time about this. Maybe they won't, right? But if you really can't grasp this concept for whatever reason, maybe I'm not explaining it really well, then I think that you can take a gamble and just say this, especially if it's early on in the coffee chat process. But near the end of it, in interviews, stuff like that, then you definitely should understand what a non-controlling interest is. And personally for me, I think I might have mentioned this in another video, but in I think it was like my second coffee chat, I had a banker from like a bulge bracket bank ask me essentially what the formula is for enterprise value to equity value. And that also kind of ties in with, well, if you just spent all that time studying accounting, maybe I wouldn't have known this formula, right? And I was able to explain it, and then he asked me what is non-controlling interest. I explained that as well, right? And that individual ended up kind of vouching for me throughout the process. I mean, he essentially went out of his way to make sure that I was being connected to more and more people. I ended up having like 15 coffee chats at that bank, and I ended up getting a super day, and I ended up getting an offer there as well, right? So that's why this specific concept is kind of close to the heart. But yeah, I do think that this is something that I have heard a majority of people say that they got at one point or another in their coffee chat process or in their interviews. So I hope that's been helpful, and we'll hop into the next video.